We're watching something unfold in real time that most participants still don't recognize as structural. Ethereum dropped below $3,000. The broader cryptocurrency market shed over $150 billion in market capitalization in 48 hours. Social media is filled with explanations about leverage, about whale movements, about technical support levels breaking. These explanations aren't wrong, but they're addressing symptoms while missing the underlying architecture of what's actually happening here. This isn't a dip. This isn't a correction in the traditional sense. What we're witnessing is the early stage of a liquidity extinction event in a market that was structurally designed to require perpetual inflows to sustain price levels, and those inflows are now reversing at an accelerating rate. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The scale of what just occurred deserves proper context. $150 billion in paper wealth vanished in 2 days. To put that in perspective, that's larger than the entire GDP of Hungary. It's more than the market capitalization of companies like Coca-Cola or Netflix. But here's what makes this particularly significant from a structural standpoint. This happened during what should be a period of relative stability. We're not in the immediate aftermath of a major regulatory announcement. There wasn't a catastrophic hack of a major exchange. No single catastrophic event triggered this. That's the tell. When markets drop this hard without a clear single catalyst, it means the underlying structure was already compromised and price was being held up by increasingly fragile mechanisms that finally gave way. The cryptocurrency market, and Ethereum specifically, operates on a fundamentally different liquidity model than traditional assets. And understanding this difference is essential to understanding why the destruction happens the way it does. Traditional equity markets have decades of institutional infrastructure, circuit breakers, market makers with regulatory obligations, and, most importantly, they're backed by cash flows from actual business operations. Ethereum and the broader crypto ecosystem are backed by a combination of speculation, narrative, and most critically, the expectation of future adoption that will justify current valuations. This isn't inherently illegitimate, but it creates a very specific kind of fragility. The entire valuation structure rests on confidence in a future state, and confidence is the most volatile asset that exists. What we're seeing now has precise historical parallels, and examining those parallels reveals why this plays out with mathematical certainty once certain conditions align. The most relevant comparison isn't to other crypto crashes, though those are instructive. The most relevant comparison is to the structured finance collapse of 2007 and 2008, and specifically to how CDOs and mortgage-backed securities behaved in the months before the broader crisis became undeniable. In that period, you had assets that were priced based on models that assumed continued appreciation and liquidity. Those models worked perfectly as long as inflows continued. The moment inflows slowed, then stopped, then reversed, the entire pricing structure revealed itself to be built on circular logic. Mortgage-backed securities were valuable because housing prices would keep rising. Housing prices would keep rising because credit was available. Credit was available because mortgage-backed securities were valuable. The circle broke, and 14 months later, Lehman Brothers didn't exist. Ethereum and decentralized finance protocols operate on remarkably similar circular dynamics. Ethereum has value because it powers decentralized applications. Decentralized applications attract users and capital because Ethereum has value and liquidity. Liquidity exists because people are staking and providing capital. People stake and provide capital because they expect appreciation. Appreciation happens because of inflows. We're now at the point in the cycle where inflows have stopped in many segments, and in some cases reversed, but price hasn't fully adjusted because of secondary mechanisms that temporarily mask the underlying reality. Those mechanisms include staking lockups that prevent immediate selling, protocols that incentivize holding through yield that's paid in the same depreciating asset, and perhaps most importantly, leveraged positions that haven't been liquidated yet, but will be as price continues to fall. There's another historical parallel that's even more precise, and it comes from the Japanese asset bubble of the late 1980s. In that period, Tokyo real estate and equity markets reached valuations that made no sense based on traditional metrics, but they made perfect sense within the closed loop of the domestic financial system, where banks lent against appreciating assets. Those assets appreciated because of lending, and the cycle reinforced itself. Foreign observers warned it was unsustainable. Domestic participants had explanations for why this time was different, why Japanese business culture and savings rates created unique conditions. The bubble peaked in late 1989. 35 years later, Japanese equities only recently exceeded those peak levels in nominal terms, and in real inflation-adjusted terms, they're still below. The Nikkei fell from nearly 39,000 to 15,000 in less than 2 years, and that was before the internet, before algorithmic trading, before 24/7 global markets. The mechanisms that can accelerate collapse are exponentially more efficient now. What makes the current cryptocurrency situation particularly vulnerable is the presence of multiple overlapping fragilities that all point in the same direction. Start with the macro environment. Global liquidity conditions have shifted dramatically. Central banks that printed trillions during the pandemic are now in restrictive mode or maintaining tight conditions. The Federal Reserve's balance sheet has contracted substantially from its peak. The European Central Bank only recently began cutting rates after an extended hiking cycle. China's economy, which was a major source of both direct crypto demand and broader global liquidity, is dealing with a property sector crisis and deflationary pressures that are leading to capital controls and reduced speculative activity. This matters because cryptocurrency, despite the decentralized rhetoric, is deeply dependent on fiat liquidity conditions. When dollars and euros and yuan are freely available, when credit is cheap, when people have excess capital beyond their immediate needs, speculative assets perform well. When liquidity tightens, when credit costs rise, when people need cash for actual expenses or to meet margin calls in other markets, speculative assets get sold first. Layer onto this the regulatory environment, which has shifted from ambiguous to increasingly restrictive across major jurisdictions. The United States has provided more clarity through recent enforcement actions and proposed frameworks, but that clarity hasn't been favorable to the freewheeling speculation that characterized prior cycles. The European Union's markets and crypto assets regulation is now in force, creating compliance costs and operational restrictions. Asian jurisdictions have largely moved to restrictive frameworks. This doesn't mean cryptocurrency is being banned, but it does mean the friction costs of participation have risen substantially. Higher friction means reduced speculation, which means reduced inflows, which means price pressure in a market that requires constant inflows to maintain elevated valuations. Then there's the internal structure of the crypto market itself, which has evolved in ways that create amplified volatility in both directions. The growth of decentralized finance meant that huge amounts of capital became locked in protocols that paid yield, often in governance tokens or the same assets being staked. This created paper wealth and reduced available supply, which supported higher prices. But it also created a massive overhang of capital that's now either unlocking on predetermined schedules or being withdrawn as yields compress, and people recognize that earning 5% in a depreciating token is a nominal gain, but a real loss. Industry estimates suggest tens of billions in staked Ethereum alone, much of which entered at higher price levels and is now underwater in fiat terms, even accounting for staking rewards. As lockup periods end and as the calculus shifts from hope for appreciation to damage control, that capital will seek exit. The market structure can't absorb large-scale redemptions without significant price impact because liquidity, despite what order books suggest, is extremely thin for size. This is where we get to the mechanism that most people miss. The reason why these events feel sudden, even though they're mathematically inevitable once initial conditions are set. Markets don't move in straight lines. They move in feedback loops. A price decline triggers margin calls and stop losses, which create selling, which pushes price lower, which triggers more margin calls and more stops. In traditional equity markets, this process is slowed by circuit breakers, by market maker obligations, by the sheer size and diversity of the participant base. In crypto markets, it's accelerated by 24/7 trading, by the concentration of holdings, by the algorithmic nature of much of the trading activity, and by the fact that leverage in crypto markets is often dramatically higher than in traditional markets. Recent data suggests that during volatile periods, effective leverage across major exchanges can reach 10-to-1 or higher on average, with some participants using 50-to-1 or even 100-to-1. When prices fall quickly, these positions don't just get stopped out, they get liquidated, often at prices well below where stops were set because order books evaporate in fast markets. The $150 billion loss in 48 hours tells us that this liquidation cascade has begun, but not that it's complete. Historical analysis of similar events in crypto and in traditional markets suggests that the initial sharp move is followed by a period of stabilization or even partial recovery, as some participants see the lower prices as buying opportunities, and then followed by another leg down as the structural issues that caused the initial decline haven't been resolved and are in fact worsening. We saw this pattern in the 2008 financial crisis, where there were multiple rallies between March 2008 and March 2009, each one greeted as evidence the bottom was in, each one followed by new lows. We saw it in the dot-com crash where the Nasdaq fell, rallied, fell harder, rallied again, then spent 2 years grinding lower. We're seeing the same pattern now in crypto because the pattern isn't about sentiment or technicals, it's about the resolution of structural imbalances, and those imbalances take time to fully work through the system. One of the most important questions in systemic analysis is why the majority of participants don't see these things coming, or, if they see them, don't act on them. The answer has to do with incentive structures and information distribution. The people with the loudest voices in any ecosystem are typically those who benefit from continued participation and optimism. In crypto, that's founders, developers, exchange operators, influencers whose audience is retail traders, venture funds with large positions. These aren't bad people, but they're systematically biased toward optimism because their wealth, their business models, their relevance all depend on continued activity and price appreciation. When you're running an exchange, you make money on volume regardless of direction, but your business grows when prices rise because that attracts new participants. When you're a venture fund with investments in crypto infrastructure, you need the ecosystem to thrive. When you're an influencer, your audience wants hopium. They want reasons to hold. They want confirmation that their positions will work out. So the information environment becomes systematically skewed toward bullish narratives, toward explanations for why downward moves are temporary, toward highlighting any positive data point while downplaying negative ones. This is compounded by the fact that the mechanisms driving systemic failure are complex and often boring. Liquidity structures, redemption dynamics, off-chain leveraged positions, correlation breakdowns, these aren't exciting topics. They don't get clicks. They don't go viral. What goes viral is price predictions, is narratives about institutional adoption, is stories about getting rich. So even when the warning signs are visible, they're drowned out by noise, and the people who might recognize them have limited incentive to publicize them and significant social cost to being early or wrong. This is why every major financial crisis is obvious in retrospect, but was dismissed by most people in real time. The information was available. The logic was sound. But the incentive structure of the system ensured that most participants either didn't see it or didn't act on it. Right now, as Ethereum sits below $3,000 and the broader market has shed that $150 billion, we're at a specific point in the pattern. Retail participants are being told this is a buying opportunity, that smart money is accumulating, that fundamentals haven't changed. Some of that may be true in pockets. But the broader structural reality is that we're dealing with an asset class that experienced unprecedented inflows during a period of unprecedented global liquidity, reached valuations that were predicated on continued exponential adoption, and is now facing a multi-year period of tighter liquidity, higher regulation, and maturing expectations where the revolutionary narrative gives way to more sober analysis of actual utility and cash flows. That transition always involves significant price discovery, and price discovery in this context is a euphemism for wealth destruction. The comparison to 1,929 in 2008 isn't about absolute dollar amounts or systemic importance to the broader economy, though crypto is now large enough that second-order effects matter. It's about the structure of the event. In both those cases, you had assets whose valuations were based on extrapolation and leverage, where the majority of participants believed the worst was behind them even as the worst was just beginning, where each decline was met with explanations about why this level would hold, and where the ultimate bottom was reached only after a complete psychological capitulation that took far longer than anyone expected. The Dow Jones didn't return to its 1,929 peak until 1,954. The Nasdaq didn't return to its 2000 peak until 2015. These aren't predictions that crypto follows the same timeline, but they're reminders that in markets built on leverage and speculation, the unwind takes much longer than the buildup, and the bottom is only reached when the last structurally weak hand has been shaken out. There's also the question of contagion and how weakness in crypto markets affects other systems. Crypto is no longer isolated. Major financial institutions have exposure through trading desks, through investments, through clients who use crypto as collateral. The bankruptcy of firms like FTX in late 2022 showed how interconnected the crypto ecosystem had become and how failures propagate. While regulatory changes have reduced some of these interconnections, they haven't eliminated them. Reported estimates suggest that several $billion in institutional capital remains exposed to crypto markets through various vehicles, and while that's small relative to total institutional assets, it's large enough that distress sales or margin calls in crypto could force selling in other markets to raise cash. More broadly, crypto has served as a barometer for risk appetite. When crypto is performing well, it suggests speculative capital is available and confident. When crypto is crashing, it suggests risk-off positioning, and that sentiment spreads to other speculative areas including small-cap stocks, high-yield bonds, emerging markets. What accelerates this particular cycle compared to historical precedents is the speed of information flow and the automation of trading. In 1929, it took days or weeks for information about price movements and bank failures to spread. In 2008, information moved in hours, but trading was still largely human-mediated during business hours. Now, information is instant and global, and trading is algorithmic and continuous. This means that feedback loops that might have taken months in prior eras can play out in days or weeks. The $150 billion loss in 48 hours is evidence of this acceleration. But it also means that the psychological processing lags behind the price action. People haven't had time to adjust their mental models, to accept the new reality, to make decisions. That adjustment period is still coming, and when it does, it will likely trigger another wave of selling as people who've been in denial or hoping for recovery realize the structural context has changed. There's a human element to this that's important to acknowledge because these aren't just numbers on a screen. Behind every percentage point decline are individuals who made decisions based on the information available to them, who believed in a technology or a vision, who in some cases invested money they needed for real expenses. Some of those people will be fine because they invested only what they could afford to lose or because they're young enough to recover. Others will face real financial distress. This isn't schadenfreude or moral judgment. It's recognition that systemic events create diffuse suffering that falls disproportionately on those least equipped to handle it. Sophisticated institutional players have risk management systems, diversified portfolios, access to credit lines. Retail participants often have concentrated positions, limited diversification, no safety net. When the market falls 50%, the hedge fund manager is unhappy but still wealthy. The person who put their savings in at the peak is facing genuine crisis. This dynamic plays out in every major market dislocation, and it's playing out again now. The objection that always comes up in these analyses is that crypto has crashed before and always recovered. Bitcoin fell from nearly 20,000 to 3,000 in 2018 and 2019, then went to 69,000 in 2021. Ethereum has been declared dead multiple times. This objection is valid as far as it goes, but it misses two critical points. First, past recovery doesn't guarantee future recovery, especially if the conditions that drove prior recoveries have changed. The 2020 and 2021 recovery was fueled by unprecedented monetary stimulus, by institutional interest that was largely exploratory and has since become more circumspect by retail enthusiasm driven by stimulus checks and forced savings. Those conditions don't exist now. Second, even if crypto does eventually recover, the relevant question is timeline and opportunity cost. If Ethereum takes 5 years to return to prior highs, and it might take longer or might not get there at all, the person who stays invested through that entire period has not only lost the inflation-adjusted value, but has lost the opportunity to deploy that capital elsewhere. The question isn't just whether the asset survives, it's whether it's the optimal use of capital over the relevant time horizon. What we're watching unfold is the convergence of multiple structural pressures that individually would create headwinds and collectively create conditions for a prolonged and severe downturn. Macro liquidity is tight and likely to remain so given inflation concerns and central bank positioning. Regulatory frameworks are tightening, raising costs and reducing speculative participation. The internal dynamics of crypto markets, with massive overhangs of staked and locked capital, with concentration of holdings, with leverage, all create fragility. The narrative tailwinds that drove prior cycles, the sense that crypto was inevitable and would revolutionize finance, have weakened as the technology has matured and limitations have become apparent. Institutional interest, which was growing rapidly, has plateaued or reversed in many cases following high-profile failures and regulatory uncertainty. Retail enthusiasm, which drove massive inflows, has cooled as people who entered during the peak are underwater and new entrants are scarce. These aren't temporary conditions. They're not sentiment-driven weakness that will reverse with a good news cycle. They're structural realities that define the operating environment for an extended period. Markets can remain irrational longer than individuals can remain solvent, as the old saying goes. But markets also eventually rationalize around fundamentals, and the fundamentals for crypto as an asset class are significantly weaker now than they were at the peak. That doesn't mean the technology is worthless or that blockchain has no future, but it does mean that the valuations reached during peak enthusiasm were detached from any reasonable assessment of near-term or even medium-term utility. And the process of reconnecting price to value is what we call a crash. As we move through the next phase of this cycle, the pattern will likely follow what we've seen in prior systemic adjustments. There will be rallies that feel like recoveries. There will be narrative shifts where people identify new catalysts for optimism. There will be capitulation events where large holders give up and sell, creating temporary bottoms that then break. The process isn't smooth or predictable in its day-to-day movements, but it's directionally consistent because the underlying forces are strong and aligned. Capital is exiting the space faster than it's entering. Leverage is being reduced through forced liquidations. Expectations are being reset downward. These processes take time to fully play out, but they're underway now, and the $150 billion loss we just witnessed is a mile marker on that journey, not the destination. The ultimate bottom will be reached when the last forced seller has sold, when valuations reflect realistic rather than optimistic assumptions about adoption and utility, when the people remaining in the market are there because they're users of the technology rather than speculators on price, and when the broader macro environment shifts back toward accommodation and risk-taking. We're not there yet, We're likely not even halfway through the process. What happens from here isn't prophecy, it's pattern recognition applied to structural conditions, and those conditions all point in the same direction.